All right, let's talk about a language that's, believe it or not, over 500 years old. And yet, it's the invisible engine powering literally every business on Earth. I'm talking about everything from the corner coffee shop to the biggest tech companies in the world. This is the universal language of business, accounting.
But seriously, just stop and think about that for a second. How does any business, big or small, really know what it's worth? Right now, at this very moment. How do they check their financial pulse? It sounds like a simple question, right? But the answer, well, it's this incredibly elegant system built on pure, undeniable logic.
See, this is the universal problem, isn't it? Every single business out there, I don't care if it's a startup or a massive corporation, faces the exact same challenge. Value is always moving around, it's being bought, it's being sold, it's being created. So the big question becomes, how on earth do you keep track of all that action in a way that makes sense to everyone involved? And that's it. That's really all accounting is at its core. You know, once you peel back all the complicated sounding jargon, it's just a system for tracking that value. Every time a business makes a move, buys something, sells something, value changes hands. Accounting, it's like the official storybook that writes down every single one of those moves, so nothing gets lost. Okay, so we've got this universal problem. What's the solution? Well, it's actually brilliantly simple. It's an idea that has been the absolute bedrock of business for hundreds of years. And don't worry, this isn't some terrifying math formula. It's just an elegant, perfectly logical framework. We call it the accounting equation.
And here it is. The whole shebang. Assets equals liabilities plus owner's equity. That's it. That's the entire foundation of accounting. The best way to think about it is like a balancing scale. It has to stay perfectly balanced always. Because everything a business owns, we call those its assets, has to have a claim on it. Either an outsider has a claim, which is a liability, or the owner has a claim, which is the equity.
So let's break that down. On one side of our scale, we have assets. This is all the stuff the business owns that has value. Think cash in the bank, furniture, inventory for sale. You get the idea. Then on the other side, you have the claims on all that stuff. Those claims are split into two types. Liabilities, that's what the business owes to outsiders, like a loan from a bank. And equity, that's what the business owes to its owners. It's their piece of the pie. And the key thing, the absolute rule, is that what you own must always equal who has a claim on it.
But wait a minute. Where did this perfectly balanced system even come from? I mean, this wasn't dreamed up in some sterile laboratory. No way. It was actually forged in the heat of necessity during one of the most exciting, explosive periods of global trade in all of history. So let's dive into that hidden story.
So picture this. It's the 11th and 12th centuries. Trade between the Italian city-states and the Far East is just exploding. You've got merchants pooling their money for these incredibly long, incredibly risky shipping voyages. They desperately needed a rock-solid way to track who put in what the profits were, what the losses were. So fast forward a bit to 1494. A brilliant Italian monk and mathematician, Luca Pacioli, comes along. Now, he didn't invent this system out of thin air. What he did was he observed what the smartest merchants were already doing, and he wrote it all down. He codified it, giving us the blueprint for all modern accounting. And the absolute genius at the heart of his work? It's something called the double entry principle. Here's the core idea. Every single transaction has a two-sided effect. Value can't just appear out of nowhere, and it can't just vanish into thin air. It has to come from somewhere and go somewhere. So, for every receiver of value, there has to be a giver. By simply recording both sides of the coin for every single exchange, the system becomes self-balancing. It literally checks its own work. And all of that boils down to one simple, powerful rule. This is the golden rule that governs everything. Are you ready? Debit the receiver of value and credit the giver of value. That's it. If you can just remember that one little phrase, you've basically cracked the code on the fundamental logic of accounting. Okay, so theory is one thing, right? But let's see this thing in action. Let's make it real. We're going to walk through a super simple example, starting a brand new business from scratch. And we're going to watch step by step how every single move keeps that beautiful accounting equation perfectly, and I mean perfectly, in balance. So let's meet Kukua. She's our entrepreneur. She's decided to start a business. And the very first thing she does is take $5,000 of her own savings and put it into a brand new bank account, just for the business. This is ground zero, the first critical transaction.
So what does that do to our equation? Let's look. The business now owns an asset, $5,000 in cash. Okay, so that's the left side. Now, who has a claim on that cash?
Well, Kukua does. She's the owner. So her owner's equity, which we call capital, is also $5,000. And there you have it. Assets of $5,000 equals liabilities of 0 plus equity of $5,000. The scale is perfectly balanced right from the start. All right, step 2. The business can't run on an empty floor, right? It needs some furniture. So Kukua buys $1,500 worth of furniture and pays for it with a check straight from that business bank account. So what does this do to our balanced equation? Now, check this out. Did you see what happened? The entire right side of the equation, the liabilities and equity, didn't move an inch. All the action was on the left. On the asset side, the bank account went down by $1,500, sure, but a brand new asset, furniture, popped up worth $1,500. So the total value of the assets is still $5,000. It's still perfectly balanced. The business just swapped one type of asset, cash, for another type, furniture. Okay, next up, a business needs something to actually sell. Kukueba buys $2,000 worth of goods or stock. But here's the twist. She buys it on credit. The supplier is cool with her paying them back later. And this is where the other side of our equation finally gets to join the party. So look closely at how both sides of the scale move together now. On the left, the assets go up. We've added $2,000 worth of stock, so our total assets are now $7,000. Now, to keep that scale from tipping, the right side has to go up by the exact same amount. And it does. We now have a liability. That's the $2,000 the business owes to its supplier. In accounting speak, we call this accounts payable. And boom, just like that, $7,000 on the left, $7,000 on the right. Still in balance. All right, now for the fun part. This is the moment every business owner lives for. It's time to make a sale. Kukua sells half of her stock. Now remember, that stock cost her $1,000, but she sells it to a customer for $6,000 in cash. That is a sweet $5,000 profit. So the big question is, where does that new value, that profit, fit into our equation? Okay, let's trace the moving parts here. On the asset side, our stock went down by $1,000 because we sold it, but our bank account shot up by $6,000 in cash. That's a net gain of $5,000 on the asset side. So what happens on the right side to match it? Well, who does that profit belong to? The owner. It increases Kukua's equity. Her claim on the business, her stake, just grew by that $5,000 profit. And what do you know? Once again, both sides balance out perfectly, this time at $12,000. And that's really the magic of it all, isn't it? No matter what we did, starting up, buying things, borrowing, and then finally selling for a profit, that equation held true. It always balances. It gives you this perfect, self-correcting snapshot of a business's health at any single point in time. It's so simple, so elegant, and just unbelievably powerful. So think about that. A system written down over 5 centuries ago is still the fundamental engine of all global commerce. Its logic is so pure, so solid, that it's now the direct inspiration for bleeding-edge technology like the blockchain. You've probably heard of triple entry accounting. That's built on this very foundation. It just goes to show you this timeless language isn't stuck in the past. It's still evolving. It really makes you wonder, doesn't it? What's the next chapter for accounting going to look like?